Hey everyone, and welcome to Opportunity Stocks. Today I'm going to be talking about the three most common stock market indexes: the S&P 500, the Dow Jones Industrial Average, and the Nasdaq Composite. I'll explain what each index is, how they're calculated, and how they've performed. I'll also explain why they're performing so differently this year. By one measure, the market is up 34%, while another is up only 6%. I'm calling this the Great Stock Market Divergence of 2023. And if you stick around to the end of this video, I'll give you an investing tip on how I'm playing the market to profit from this unusual divergence in our Opportunity Stocks investment portfolio. All right, let's get started. Since we're talking about the stock market performance, let's first review what is the stock market. The stock market is a marketplace where people buy and sell shares of ownership in companies. When you buy a share of stock, you're essentially buying a small piece of a company. The stock market is a way for companies to raise money from investors, and it's a way for investors to make money from buying and selling shares of stock. Now that we know what the stock market is, how do we measure it? The most common way to measure the stock market is to look at an index. An index is a group of stocks that are grouped together based on a set of criteria, and they allow investors to measure their performance. Indexes are often used to track the overall health of the stock market. When investors talk about stock market returns, they're usually talking about the S&P 500. The S&P 500 is the most widely followed stock market index in the world. It includes 500 of the largest companies in the US by market cap. Market capitalization, or market cap for short, is calculated by taking the stock price times the total shares outstanding. For example, if a company's stock price is $10 a share and they have 100 shares outstanding, the market cap is 1,000, 10 times 100. Created in 1957, the S&P 500 index was the first index in the US to be weighted by market capitalization, which means that the stocks with larger market caps have a bigger impact on the index's performance. With a market cap of over $3 trillion, Apple has a weighting of nearly 8%, the largest company and therefore the largest weighting in the S&P 500 index. To put $3 trillion in perspective, that is larger than the entire gross domestic product of France for just one company. Next, we're going to talk about the oldest stock market index in the world. Created back in 1896, the Dow Jones Industrial Average tracks the stocks of just 30 large companies. The Dow is also weighted by stock price instead of market weight, which means that the stocks with the higher prices have a bigger impact on the index's performance. With a stock price of over $500 per share, United Health has more than a 9% weighting in the Dow. Admission to the Dow has an interesting quirk in that the index is limited to adding companies that don't already have high stock prices, since their inclusion would have too big an impact on the index's performance. On the plus side, the Dow tends to be more stable than the other indexes in down markets. As to be added, companies must have an excellent reputation, a history of sustained growth, and significant interest among a large number of shareholders. These are the blue chip stocks. Although the Dow is one of the most commonly followed stock market indexes, many investing pros consider it to be a subpar representation of the overall US stock market, given just 30 stocks, compared to a broader market index like the S&P 500. Last but not least, the Nasdaq Composite Index is known for its high concentration of technology stocks. The Nasdaq, which stands for National Association of Securities Dealers, automated quotations, includes all the stocks that trade on the Nasdaq Stock Exchange. Like the S&P 500 index, it is weighted by market cap. If you've been following Opportunity Stocks, you know the Magnificent Seven, the stocks of the 7 largest companies by market cap on the Nasdaq, which make up more than 50% of the index. I'll also point out that these same 7 make up about 30% of the S&P 500 index. To learn more about these Magnificent Seven, I'll drop a link down in the descriptions. Along with the Nasdaq Composite, you may also hear the term Nasdaq 100, which is actually another index that includes the largest 100 companies by market cap on the Nasdaq Stock Exchange. Dominating the financial news in the past week has been the required re-weighting of the 5 largest companies in the Nasdaq 100 index, reducing their collective index weighting from 46.7% down to 38.5%. Just 2 of the Magnificent 7 narrowly escaped being reweighted as well. Why were these stocks targeted, and how did this happen? The Magnificent 7 have outperformed the rest of the market, and their stock prices have increased dramatically so far in 2023, with mega cap names like Nvidia up over 200%. They have led the Nasdaq Composite Index up over 34% higher so far in 2023, and that's compared with just 18% for the S&P 500 and only 6% for the Dow. So why such a divergence? There are a few reasons why the 3 most commonly used stock market indexes have performed so differently this year. One reason is that the Nasdaq Composite is more heavily weighted towards technology stocks, which have outperformed the other sectors this year. Another reason is that the Dow's 2 biggest sectors are comprised of large financial and healthcare stocks like United Health, which, as we discussed earlier, have underperformed. The Dow also doesn't have as much exposure to technology stocks like the S&P 500 and the Nasdaq. In sum, the 3 stock market indexes are all important measures of the health of the overall stock market. However, they each have their own strengths and weaknesses. The S&P 500 is the most widely followed index, but it's not as sensitive to the performance of individual stocks. The Dow Jones Industrial Average is a more sensitive index, but it's not as representative of the overall market. And the Nasdaq Composite is a good measure of the performance of the technology sector. And with tech having its best first half of the year in over 40 years, my bet is that the rising tide lifts all boats, and underperforming stocks in the market play catch up in the second half of the year. In other words, if we are truly in a new bull market and the top 7 names, i.e. the Magnificent 7, rotate out or at least take a breather in the second half, we should see a broadening out to the rest of the market. Now, to play this investment thesis, I'm buying an equal-weighted S&P 500 exchange-traded fund, or ETF, ticker RSP, for the Opportunity Stocks investment portfolio. As we know, the S&P 500 index is market cap weighted, so this ETF invests in the same 500 stocks as the index, but with equal weights for the 500 stocks. A little bit different. Given the main driver for the S&P 500's gains has been the Magnificent 7, the variance between the equal weight and the market weight S&P 500 is the largest it's ever been, about 10% when I last checked. So I expect this gap to narrow, with the equal weight outperforming the market cap weight over the next 6 to 12 months. That's also the cool thing about investing in ETFs. There are hundreds, if not thousands, of ETFs that allow you to play every angle of the stock market. You can even bet on country-specific markets like Mexico, ticker EWW. You can invest in sector-specific areas like the Nasdaq 100 through Cubes, ticker QQQ. And in this case, I'm betting the equal weight S&P 500 ETF, ticker RSP, outperforms the market cap weight S&P 500 ETF, ticker VOO or VOO. This is why investing in stocks is so exciting. You can do your research and take educated risks. On that note, if you want to follow along on our investment journey, go ahead and smash those like and subscribe buttons. I'll be sure to highlight all of our trades right here on YouTube for our $10,000 Opportunity Stocks investment portfolio. Also, don't forget to grab your free stocks at SoFi Invest. If you sign up with the link in the description, you'll get $25 in free stock as of the published date of this video. And as a reminder, I'm not a licensed financial advisor, so please do your own research before making any investment decisions. There's always a risk of loss when investing. Well, that's it for this video on the great stock market divergence of 2023. Thanks for watching. Be sure to check out our latest videos and shorts. Thanks again, and I can't wait to see you on the next video.